If you've spent any time scrolling through crypto Twitter recently, you've probably seen countless charts claiming that crypto prices closely follow global liquidity. But how accurate is that claim? How exactly do you measure liquidity? And why does it have such a profound effect on the crypto markets? Well, today we're breaking down precisely what liquidity means, how it shapes crypto markets, and most importantly, how you can use this knowledge to your advantage. Trust me, folks, this is a video you do not want to miss. Right, let's start by making clear what liquidity actually is, because this term gets thrown around a lot these days. Put simply, liquidity is just a fancy term that refers to how much money is flowing through the economy and financial markets at any given time. Think of liquidity as the fuel. When there's plenty of fuel, asset prices typically climb higher. When fuel runs low, markets tend to stall, or worse, experience a downturn. And this explains why liquidity has become the hot new indicator that everyone is watching closely. Now, to properly grasp how liquidity flows through the markets, there's an analogy here that could be helpful. Imagine the financial system as a giant swimming pool. At the shallow end, you have your lowest risk assets, and these are things like government bonds and high-grade corporate debt. Investors usually start here whenever there's new liquidity entering the system. Why? Well, because bonds, especially US government bonds, are considered among the safest assets in the global financial system. However, for this liquidity to flow into the deeper parts of the pool, macro conditions need to be neutral to bullish. And you can think of these macro conditions as how calm the water is. When the water is calm, i.e. meaning there's minimal political or geopolitical uncertainty, there's strong employment and controlled inflation, liquidity naturally moves deeper into the pool. Under these calmer conditions, investors become more confident and start moving towards medium risk assets such as stocks. And these assets offer investors more potential upside than bonds, but they're also riskier and more sensitive to changes in the broader economy. Finally, at the deepest end of the pool, you've got high-risk assets like cryptocurrencies. A crypto tends to attract liquidity only after investors have grown very confident and risk-tolerant. However, because the water is choppier out at this deep end, confidence can vanish rapidly when macro conditions worsen due to geopolitical tensions, political instability, or economic downturns. Liquidity then quickly flows back out, resulting in the sharp and sudden price crashes we've all become accustomed to in the crypto markets. This analogy highlights an essential point. Crypto is particularly sensitive to liquidity changes precisely because it occupies the riskiest part of the financial pool. And research from liquidity experts suggests that it can take as long as 2 months for new liquidity to find its way into the crypto markets. Yet, when market conditions become uncertain, liquidity can exit crypto markets far more quickly than it entered. Now, something important to remember here is that liquidity itself isn't straightforward to measure. While plenty of crypto Twitter analysts swear by specific indicators, no single measurement perfectly captures the full picture. And that's because liquidity isn't driven solely by one factor. It's influenced by many moving parts, including central bank policies, commercial banking activity, fiscal stimulus from governments, and even market psychology. And most importantly of all, guys, if you're enjoying this video so far, then let it be known by smashing that like button down below. You've also noticed that at least 60% of the people who watch these videos are not subscribed to the channel yet. So if that's you, you can change that right now by hitting the subscribe button, and you may as well hit the bell as well, just for good measure. Back to the video. Anyways, despite the complexity, there are ways analysts try to measure liquidity, like tracking global M2 money supply and the Global Liquidity Index, among others. Which brings us to the next logical question, and that is, how do you measure liquidity? And perhaps more importantly, how can you follow it yourself? As I mentioned earlier, liquidity isn't something you can measure perfectly with just one indicator because it's shaped by many complex forces. Thankfully, there are a few proven metrics that can reliably show you the direction liquidity is flowing, even if no single indicator provides the entire picture. The first indicator that many analysts rely on is the global M2 money supply. Now, without getting overly technical, the global M2 simply refers to the total amount of easily accessible money floating around major economies. Things like physical cash, checking accounts, savings deposits, and money market instruments. Analysts typically use global M2 as a way to figure out whether liquidity conditions are generally improving or deteriorating. And it's a good place to start, particularly because it's measured in the US dollar terms, which is the world's reserve currency, meaning it directly influences global financial conditions. However, one major limitation of the global M2 indicator is that it only measures the total amount of accessible money available in the economy, but doesn't account for how freely or how quickly that money is actually circulating or being spent. For instance, during times of economic uncertainty or geopolitical tensions, investors and consumers often hold onto cash rather than spend it or invest it, meaning liquidity doesn't actively reach riskier markets like crypto. And that's why some analysts prefer using a more comprehensive liquidity indicator, like Michael Howell's Global Liquidity Index, or GLI. Howell's GLI specifically tracks liquidity by measuring the short-term liabilities of banks and shadow banks, as well as cash flows from households and corporations. Put simply, the GLI directly captures how much money is actually flowing through the private financial sector, giving a clearer, real-world view of global liquidity conditions. And what makes Howell's indicator particularly valuable is its impressive predictive track record, as his research has consistently managed to forecast major liquidity-driven market shifts months ahead of time. Currently, Howell expects global liquidity to peak somewhere around the third quarter of 2025, which, as it so happens, lines up closely with many predictions for this cycle top sometime later this year. And if you're curious to see what we're expecting for 2025, then be sure to check out our dedicated video on that right over here. I digress. In practice, though, the best strategy isn't just picking one indicator and running with it. Instead, experienced investors tend to cross-reference multiple sources. For instance, if global M2 is rising, the GLI is rising, and other analysts you trust, say Julian Bittel from Real Vision or Ben Cowan, are all pointing to bullish liquidity conditions, you probably have a reliable signal emerging. Speaking of Ben Cowan, he's recently made an interesting point suggesting that crypto markets might sometimes front-run global liquidity measures. In other words, investors anticipate improving liquidity conditions and start pricing in future liquidity growth ahead of time, causing crypto prices to either match or temporarily run ahead of existing liquidity measures. That said, while liquidity indicators aren't about pinpoint accuracy, they're incredibly useful tools for understanding overall market conditions. Keeping an eye on global M2, Michael Howell's GLI, and insights from reputable analysts provides a well-rounded picture, helping you anticipate when crypto markets might surge or stumble.
Oh, I didn't see you there. Well, now that I've got you, I may as well let you know about the Coin Bureau deals page. It's over there where you'll get $100,000 sign-up bonuses on the best exchanges in crypto, as well as 60% trading fee discounts on said exchanges. And you can also get discounts on hardware wallets. All of that in the Coin Bureau deals page down below in the description. Now you go back to the video, I'm going back to chillaxing.
Alright, now that you have a firm handle on measuring liquidity, let's dive straight into why liquidity has such a profound impact on crypto prices. To properly grasp this, we need to start by thinking about investor psychology and leverage, two factors that have the practical effect of amplifying liquidity's effect. First up, investor psychology. Now, crypto markets, more than almost any other asset class, are driven heavily by fear and greed. When liquidity is abundant, investors become optimistic, comfortable with taking risks, and they naturally drift into crypto. After all, Bitcoin and other cryptocurrencies more broadly have historically been one of the best performing asset classes, and everyone wants a piece of that action. However, this optimism quickly escalates into greed. When investors see prices rising, they don't just buy with their available cash. They start borrowing money to buy even more crypto, confident prices will just keep on going up. And this phenomenon is known as leverage. And in crypto, leverage is everywhere. Traders open leverage positions on exchanges, institutions borrow money from banks, and crypto whales borrow against their Bitcoin and Ethereum holdings to invest in riskier altcoins. Initially, leverage makes crypto prices soar far beyond what pure liquidity alone would suggest. And this is why during bull market peaks, cryptocurrencies tend to decouple to the upside from liquidity indicators, with BTC and altcoins skyrocketing to levels that seem irrational. But Here's the problem. Leverage cuts both ways. When liquidity conditions begin to tighten, crypto investors, especially those who've borrowed heavily, can face margin calls. They're often forced into selling their positions, triggering large-scale liquidations. This forced selling conversely accelerates price declines, far beyond what liquidity indicators would typically suggest. Consider the crypto market crashes we've seen previously, like in 2022 following the collapse of FTX. These downturns weren't just caused by reduced liquidity, they were magnified massively by leverage. The sudden evaporation of borrowed money forced whales and traders to liquidate their positions, creating severe downward pressure on prices. Now, it's worth remembering a crucial point highlighted by analysts like Lynn Alden. Over longer periods of time, say months to years, Bitcoin remains highly correlated with global liquidity. But in shorter periods, crypto-specific factors like leverage and speculative excesses often cause substantial deviations, both upwards and downwards. On-chain metrics can also give clear evidence for these leverage-driven market extremes, but more on that in a bit. In other words, liquidity sets the direction, but leverage and investor psychology determine how extreme price moves become. It's not just about how much liquidity is in the system, but also how aggressively investors are borrowing and speculating based on that liquidity. Now, by this point, you're no doubt wondering, what actually influences liquidity itself? Well, broadly speaking, liquidity flows are influenced by two distinct sources: macroeconomic factors and crypto-specific sources. Let's begin by exploring the macro side, as it's typically where most liquidity originates. Now, most people assume that liquidity primarily comes from central banks, and to be fair, they're partly right. Central banks create liquidity in two main ways. Firstly, through quantitative easing, or QE, which basically means central banks printing money and using it to buy financial assets like government bonds. And this pushes down bond yields, making borrowing cheaper for everyone. And the second way is by directly lowering short-term interest rates, which makes lending cheaper and encourages borrowing and increases the overall supply of money available in the economy. But central banks aren't the only players in the liquidity game. Commercial banks also play a crucial role, and they're often misunderstood. Commercial banks create liquidity through lending, specifically by borrowing short-term money at low interest rates and then lending it out longer term at higher interest rates, pocketing the difference. Interestingly, commercial banks don't always directly follow central bank policies. Even when central banks raise short-term interest rates to reduce borrowing and slow down the economy, commercial banks don't always follow suit immediately by increasing the rates they pay on customer deposits. Instead, they often keep these deposit rates low, even as loan rates rise, and this approach widens the difference or spread between what banks pay depositors and what they earn from lending out that money. As a result, banks can remain profitable, continuing to lend and inject liquidity into the economy, even when central banks tighten monetary policy. Then, of course, we have government spending itself. Governments typically spend money they've raised by issuing bonds. When governments actively spend, like stimulus checks or infrastructure projects, it injects money directly into the economy, boosting liquidity. However, when governments reduce spending or actively refill their treasury accounts by issuing new debt, liquidity can temporarily tighten, and we've seen this dynamic clearly illustrated in the recent US debt ceiling showdown. The inability to issue new debt has forced the government to draw down its Treasury General account, temporarily adding liquidity into the markets. However, when the debt ceiling is eventually raised, refilling the account could quickly reverse the effect, removing liquidity from the system. Beyond government and banking activity, there's another powerful source of macro liquidity: rising asset prices. Essentially, when prices of stocks, bonds, real estate, or crypto rise, investors feel wealthier. They then use these appreciating assets as collateral to borrow even more money, often reinvesting that money back into the markets. And this creates a positive feedback loop of sorts, amplifying liquidity conditions and market optimism. But here's an important caveat. Macroeconomic uncertainty can quickly disrupt liquidity flows. Factors like bond market volatility, political instability, or tariff disputes can make investors hesitant. For example, when US government bonds, which act as the global benchmark for collateral, become volatile, investors tend to borrow less against these bonds, which temporarily reduces liquidity around the margins. Now, alongside these macro sources, crypto markets themselves can generate substantial internal liquidity. And this primarily happens when large crypto holders, or whales, borrow stablecoins against assets like Bitcoin or Ethereum rather than selling them. This borrowed liquidity often flows directly into altcoins, creating crypto-specific liquidity booms. And what's interesting is that this crypto market cycle could be the first in history where we see widespread borrowing against major altcoins like XRP and ADA, as well as tokenized real-world assets, or RWAs for short. We might even see new crypto regulations enabling traditional institutions like banks to offer loans against assets such as Bitcoin ETFs. Speaking of which, if you're keen to learn how crypto lending and borrowing could evolve during this crypto cycle, then be sure to check out our video on that right over here. Now, all this means that crypto liquidity isn't solely reliant on external money flowing into crypto markets. Internal borrowing and reinvestment within crypto can also significantly boost liquidity levels. Given increased regulatory clarity and institutional participation in the crypto markets, we're likely to see these crypto-specific liquidity sources in play more than ever before. All right, we've now covered what liquidity is, how it's measured, why it impacts crypto prices, and the key factors influencing liquidity itself. However, one crucial question still remains. How can you use all this knowledge to actually navigate the crypto markets? Well, first things first. While liquidity is undoubtedly powerful, it shouldn't be the only tool you rely on. As the famous saying goes, all models are wrong, but some are useful. Liquidity measures are incredibly useful, but only when combined with other crypto-specific indicators and on-chain metrics. On-chain data can provide some of the clearest signals to determine when crypto is getting overheated or oversold relative to liquidity. So let's look at two of the most important on-chain metrics. First is Bitcoin hodl waves, and this indicator tracks how long BTC has been sitting idle in wallets. Historically, at crypto bull market tops, we see long-term holders selling to eager new investors, what you might call crypto tourists. A sharp decline in Bitcoin's one-year hodl wave often indicates that experienced investors are cashing out at market peaks, suggesting crypto has overshot liquidity conditions and prices might eventually reverse. And then there's Bitcoin's market value to realized value Z-score, or MVRV Z-score for short. It essentially measures how much unrealized profit Bitcoin holders currently have. And when this indicator spikes significantly, it's historically been a strong warning sign that the crypto market is overheating. Investors sitting on unrealized profits usually rush to lock in gains at the first sign of trouble, causing prices to sharply drop. That being said, there are dozens of other useful indicators out there, and exploring them in more detail would easily require a dedicated video on the topic, which we also happen to have right over here. Now, by tracking both liquidity conditions and on-chain metrics, you can get a clearer picture of market extremes at times when crypto is likely to deviate sharply upwards or downwards from liquidity fundamentals. If liquidity conditions appear to be supportive, but indicators such as the MVRV or hodl wave suggest the market is becoming overheated, it's probably a good time to proceed cautiously. But liquidity insights aren't just useful for timing market exits, they can also help you identify entry points. During bear markets, crypto prices tend to fall far below the fundamental liquidity levels due to forced liquidations and investor panic selling. During these times, liquidity metrics can show you that the market has overcorrected, presenting potentially attractive buying opportunities. However, one critical thing to keep in mind here is that the aforementioned new crypto-specific sources of liquidity could make the next bear market even more severe than the previous cycles. As we saw vividly during the events like the Terra collapse and the FTX meltdown, massive leverage can lead to brutal liquidations. When liquidity eventually tightens, whether due to interest rates, central bank policies, or macroeconomic uncertainties, the downturn could become incredibly harsh. And that's exactly why liquidity indicators and on-chain metrics should always be used together. By taking advantage of liquidity-driven opportunities and keeping a close eye on leverage-driven risks, you put yourself in a strong position, knowing exactly when to enter the market, when to lock in those gains, and when to safeguard your hard-earned capital. Now, if you enjoyed that video, you're going to absolutely love our latest one right over here. And if you're not subscribed to the channel yet, you can do so right over here. That's me for now. Thank you very much for watching, and I'll see you again soon.